Go out, seek a mentor, spend some money on your education, invest in yourself. You don't want to make the $172,000 mistake. If I had a mentor, I probably would have had that money in the bank still because I wouldn't have done a deal.
You're listening to the Millionaires Unveiled podcast, where you'll hear the stories and interviews of everyday millionaires. We'll unveil their decisions, their strategies, and their current portfolio allocation. Now to your hosts, Clark Sheffield and Jace Mattinson.
Alrighty, episode 152. Welcome back to the Millionaires Unveiled podcast here with Jace. Jace, what's going on? How are you?
Not a lot. How you doing?
Good. Doing well. Everything going on our end. Fall is approaching, right? Weather's cooling down all over. We talked about football last time. There's more games starting to be canceled. We'll see what's going on, but pretty interesting.
Yeah, there's all sorts of crazy things. You know, I think we're going to open up a little bit more in Texas. Cases have been going down. So we'll see. It's going to be, we got a political election here coming up. It's going to be an interesting fall season for sure.
Yeah, and interesting too, right? Because just the news just broke that Ruth Bader Ginsburg passed away.
Yep.
So that's going to have a play in the election too. So yeah, I mean, 2020, what a year, right?
No kidding, man.
What a year with everything going on. Even without COVID, it's been quite the year, right?
Yep.
So pretty interesting. One thing we were chatting about, and one thing we've asked millionaires more often on our show is 30-year versus 15-year mortgages. And I think you and I can both say, as we've interviewed all these millionaires, that's one of the things that has really stood out to us, right? Is there'll be people with a net worth of $3, $4, $5, $6, $7, $10 million that still have a primary mortgage on their home, right? Yep. And that stood out to me, right? Because I think, and I could be mistaken, but I think in The Millionaire Next Door, they talk about paying off the mortgage, right? And of course, Dave Ramsey does. But I've been surprised that, what do you think? 75, 80% of the millionaires that we've interviewed are okay with keeping, maybe less than that, maybe 60% are okay with keeping a primary mortgage if it has a low interest rate.
Yeah, no, it is surprisingly quite a few, more than I would have ever thought when we first started this podcast. And, it begs the question, which one's better? Why would you do one versus the other? And there's one millionaire, Stephen Adcock, wrote an article and he said, do a 30-year. Mainly because of the flexibility. Rates are close enough. Obviously, you'll save some interest in the long term if you do 15-year, but he says do 30, give yourself some flexibility. Personally, I've done both. I've got mortgages out there that are 30. I got some that are 15, so I don't know what the answer really is. I have a preference. Depends on what the rate environment is and what the purpose of that property or what that mortgage is going to be used for in my own personal life. But it begs a question, for our listeners too. It'd be interesting. I don't know if we could create a poll with most of them, but just to see across the board if what we're finding in our millionaires is pretty consistent amongst people who are non-millionaires or even some of our listeners that are millionaires too, what that breakout is.
Yeah, it's been interesting for sure. And I think something we're willing to dive, we want to dive more into, right, is, hey, 15 versus 30 year and why. What's driving that? And for those that have refinanced or taken out a HELOC, home equity line of credit, right? What's the reasoning behind that? So pretty interesting. I think we got into that a little bit with last week's guest, if I remember correctly. That was Doc G. He had a net worth of over $7 million. We had him previously on the show about a couple of years ago, 2.5 years ago, I think, right? So It was fun to touch base with him again. He had grown his net worth about $1 million. And I thought the most interesting piece, or one of the most interesting pieces about that interview, was he had a net worth of 7.5 currently. He mentioned he was making close to $1 million a year, I think 850, 900, and just asking him, hey, when was the right time to walk away, right? When is enough for you? And I mean, at that amount of money, you start looking at it and you say, gosh, if I work one more year, that's another $500,000.
Yeah.
Right.
Yeah.
So I thought that was an interesting piece of the interview. And he just said, look, when you win the game, there's not really more you can do, right? Like,
there's no overtime.
Enough plus 10 doesn't really get me anywhere.
Yeah.
So that's one thing that stood out to me on last week's interview. This week we have a fun interview with Gino. He's a guest interview, real estate investor. And again, we'd just like to highlight some guests, whether it's about real estate or the stock market or money and marriage, a variety of episodes just to bring a unique take and a unique perspective to the show. So a fun interview today with Gino. If you enjoy the show, we invite you and would like you to please leave a review on iTunes, Stitcher, whatever platform you listen to. It helps grow the show. We got one this week from Shenandoah Valley. says, I am really enjoying the Millionaires Unveiled podcast. Great to hear so many unique perspectives and paths to wealth. This is the first podcast I listen to every Monday when it drops. So thanks to Shenandoah Valley for that. If you're interested in sponsoring the show, send us an email, or if you'd like to be on the show, always welcome new millionaire guests or those who are close to a millionaire. Our email is millionairesunveiled@gmail.com. So thanks so much for listening to the show. Hope everybody is staying safe and healthy. And without any further delay, please help me welcome Gino to the show.
Gino, do you want to just give us a little bit about your background and kind of what you're up to now?
Good morning, Jace. Thanks for having me on. I started out in the restaurant business, getting out of college. Couldn't get a job back then, a long time ago. And I loved it. I was working with the family. I actually worked with Dad every day and my brother, and we didn't kill each other for about 20 years. We had a good run up until 2008. And 2008, the Great Recession came, and it feels eerily similar right now. It seems like everything stopped back then. No business. Banks were seized up. Didn't know what to do. I said, I've got 6 kids. I got to figure something out. Got to make some money somewhere. So I just said to myself, see passive income. And I started looking in real estate. And, the first couple of ventures I went into, I bought a mobile home park, big mistake. I got into a mixed use property up in upstate New York, up in Dutchess County, big mistake. And then it just landed on, I said, let me look at multifamily. I don't want to fix and flip. I don't want another job. And I got into multifamily and I just started coaching. Went out and seeked a mentor, found a mentor. And luckily for me, in 2011, I met Jake. And Jake is was a pharmaceutical rep. He was getting catering out of my restaurant. He knew my brother really well. And I had a couple conversations with him, but in 11, he's like, I'm moving down to Knoxville. I'm like, Knoxville? What's Knoxville? Where's Knoxville? We were talking about New Yorkers. New Yorkers don't know anything out of the tri-state area, right? So I'm like, okay, go to Knoxville. And, we whipped out the computer and I'm looking at these deals, in Loopnet. Back then, deals were trading for 30 a door. I'm like, wow, this looks really interesting. I said, Jake, when you get down there, let's start looking at multifamily. And, he got down there, went by himself. His future wife was up in New York for another 6 months, so he was lonely. So we're looking at deals. And it took us about 18 months to find that first deal. But back in February of 13, we bought that first 25-unit deal together. And then after that, 3 months later, we bought a 36-unit. And then 6 months after that, we bought 136 units. So for us, it took us a long time to get that first deal. But then after that, eerily similar to what's going on right now. Back then, there was a lot of deals out there, but there was no money. And it seems like it's flipped that way now, where the brokers would really work with you. There was actually listings with deals. It's just the sentiment back then, consumer sentiment was terrible. You had 1% GDP growth. There was no rent growth at all. It was just a slow time, and we just started buying at the right time.
That's awesome. I want to get into what you're doing now, but you said you bought a mobile home park and that was a mistake. Why was that a mistake?
Well, it's funny, Jace. The mobile home park wasn't a mistake. I was the mistake. I got into it because, when you have a little extra money, and I always tell people, a person with money meets a person with experience, and the person with the experience gets the money, and the person with the money gets the experience. And that really happened to me because I had no idea about the space. All I knew is I had a few extra bucks in the bank, and I'm like, you know what? Everyone says, invest for passive income. And that's what I did. I had a friend who put me onto somebody else and said he was buying mobile home parks in Florida. And I knew nothing about the space. I didn't even do due diligence at all. I didn't fly down to see the property. I took his numbers at his word. He basically created a syndication. I didn't know what a syndication was back in 2005, 2006. And it was just a good deal for 6 months. And then after that, the wheels fell off the deal. But it was totally my fault. I didn't know what due diligence was. I didn't know how to analyze a deal. I didn't know what a cap rate was. I didn't know anything. And if I had to do it all over again, I would have said to myself, let me fly down there. Let me take a little bit more control. Let me do my due diligence and, let me get more educated on the space. And unfortunately, after 6 months, that deal just went bye-bye. And it was painful for a couple of years. And for me, it was a great learning experience. And that's when I think I ultimately said to myself, you have to be responsible for your own actions. I could blame that guy every day of the week. It's not going to change the fact that I got into a bad deal and I didn't know what I was doing.
So did you end up losing all of your capital investment in that deal?
$172,000. I sure did.
Oh
Painful.
My gosh, that's painful.
Very painful. Very painful. You know what? So when I tell people, go out, seek a mentor, spend some money on your education, invest in yourself. You don't want to make the $172,000 mistake. If I had a mentor, I probably would have had that money in the bank still because I wouldn't have done the deal. So.
Wow, that's crazy. So was that the first investment that you went after, or did you invest any money in the stock market or other ventures before that?
I had always been active in the stock market. When I got out of college in the 90s, Value Line was there. It was a different time to invest in the market. Now, it seems like in the last 10, 15 years, you can, there's a swing of 1,000 points in 2 days. You can lose 10% in 2 days. Back then, stock market was slower. There was less information out there, less algorithmic trading. So for me, it was more fun. I had a fourplex also. So I had bought a fourplex previous to that. And with this, it felt like it was easy money. And Jace, when you think it's easy money, it's never easy money.
Right. So the fourplex and then this was the first kind of real estate that you bought. Maybe you had a single family home or your primary residence rather.
Primary residence. Yep.
Okay. Gotcha. And so you and Jake had just maybe saved, tell me if it's accurate, just saved money. And that's how you were able to buy these first few deals. Is that right?
Yep. No, the first deal we had 10% order financing. So
nice.
The bank that was holding the mortgage on the property when we bought it they said, hey, you know what? We can allow you to hold 10%. The sellers can hold 10% as part of the down payment. So it was a $600,000 deal, 25 units. So we needed to come up with around $80,000 in cash to close the deal. So it was me, Jake, and my brother Mark. All three of us as partners. The second deal, I actually brought on my current partner, Mike, and it was four of us on our second deal. It was a 36 unit, $850,000 deal. And then the third deal, it was me, Jake, and Mike. Mike had a strong balance sheet. So, in multifamily, it's a team sport. Mike had a stronger balance sheet, got money wherever we could, whether it was a 401k, whether it was our home equity lines of credit. And after that, it took us about 18 months after that third deal where we were able to refinance and pull a ton of equity out of all three of the first deals we did. So from that's how we kept repurposing our capital, putting it into the next deal and putting it into the next deal.
So this first deal, let's talk about that a little bit, because like you said, I think the first deal takes the longest and is the hardest, right? And then it kind of snowballs from there, and that seems to be what happened with you guys. So was this one in Knoxville, the $600,000?
It was. Yeah, the first 1,000 units of our portfolio were all in Knoxville market. Some in East Tennessee. What happened with us was we just started managing our own deals. Jake was, had that pharmaceutical rep job. He was a sales guy, so he had the flexibility to go and manage the property. We had resident managers on that first deal and the second deal, but we wanted to manage. We wanted to learn how to self-manage our own property, and we just continued to manage our own stuff. But we're basically vertically integrated. And for us, it was a great learning experience. He got paid his 10% management fee for the first couple of deals. It allowed him, along with cost segregation, to get out of and quit his job within 18 months of buying that first deal. And the great thing about the first deal was it was a mom and pop, like all of our deals. It was just a distressed seller. They wanted to sell. They were weekly renters in there. Their expenses were out of control. They were just, renting to anybody, a lot of deferred maintenance on there. And, the first deal is always the toughest because you have no systems yourself. You have no team. So we went in there without a contractor. We went in there, basically with an inspector the last a week we got. And it was tough because it was something different. And, the tenants were a little bit, how can I say? They were rough. They were weekly renters. We got sued like the first 3 months by a tenant who, it was his own furniture, and he was suing us because of bed bugs. I'm like, how can somebody sue us because of bed bugs because of their own mattress? So it was just a complete learning experience. The first 6 months, somebody passed away in one of the units. It was really a tough learning experience. And the hardest thing about that was just re-tenanting the whole property from weekly renters to monthly. And once we did that, the property stabilized. We had much better tenants. We had much better cash flow. The mail lady actually said, you know what, guys, it's really nice to deliver mail to this property again, because it was a rougher property, but it was only 25 units. And, everyone's always telling you got to go big on your first deal. You got to go big. And for us, thank God we only bought 25 units because the septic fields failed, like I said, and the lady passing away in the property and collecting the rents. And it was a really great learning experience for us, where the second deal was 36 units. And then the third deal was 136. So I always tell people it's not how big you start. It's just start, get the experience, see if you like it, learn the systems, and then you can start scaling up.
Yeah, good stuff. How did you find it?
The first two deals, the first deal was on Loopnet, believe it or not. It was sitting there for a couple of years. And I think that's what's going to start happening now in this cycle. You're going to start seeing deals being deposited on CoStar and Loopnet sitting there for a while. And this deal had been sitting there for, a couple of years. They were asking $750,000, and we put in an offer at $600,000. We probably could have gotten it for $550,000, but when you're first starting out, you have no idea how to negotiate these deals. So we got it through that. And the best thing about it was we found the broker. That broker on that first deal has been a broker for, I'd probably say 700 to 800 units. And he just, he was a great resource. He was an excellent guy. He'd been doing real you do what you say and you say what you do. You close the deals, you call them back, you underwrite the deals, you put in fair offers, and you create a great relationship with a broker, and they will make you rich.
I mean, it's still pretty amazing, right? It's 20% off the asking if you got it for 600 from 750.
And that's what it was. And back then, on the third deal, it was a 136 unit deal, and it was, listed at 6.3 million. Same thing. You had a mom and pop. He was a doctor. His wife was managing the property. We ended up buying that property for 4.075 million. So, I mean, that's 2.3 million off the asking price. And I always tell people this, the last couple of years, it's been difficult, but if you can substantiate your underwriting with actuals, and we're going back to that time where we're going to actually be buying property on actual numbers. It's amazing. We're coming back full circle. I think the market is coming back to that, where you can put in fair offers based on actuals, based on actual cap rates and actual income and expenses. You can show your underwriting, and you can put 10 or 15 or 20% below asking, because I think a lot of these brokers were just overshooting. And you know what? There's so much capital in the market. Cap rates were compressing that people were willing to overpay, and people were writing down, 5% rent increases, 1% expenses, and they were just, buying on what's going to happen 2 years from now. So I think we're coming back to that point where actuals are going to make a big difference.
Yeah, that's what I was going to say. Do you think we're headed, and just for our guests, we're recording this mid-April, because, even in Knoxville, I just went on Loopnet and found I think it was just a 12 unit or something, but it was like a 4 cap. Mm-hmm. And I'm like, this is crazy, right? You're buying in New York at almost now than a 4 cap, and you're asking for this little 12-plex that's way outside of the city for it makes it, the numbers didn't make sense, but you think that's kind of the way it's trending.
Well, Jace, I'm not sure what's going to happen with the financing. The financing piece is going to be very big. We started out buying with community banks, and back, 13, 14, 15, there was no Freddie SBL. The agencies were there, but they weren't as prevalent as they are now. And I loved community banks. They're easy to work with. Basically they're just, you walk in there, you talk to the decision maker. Our LTVs at the time were 80% LTVs. Now, the last couple of deals we've done with communities, they can go up to 85% LTV. Mm-hmm. They're very flexible. I mean, they have 25-year AMs as opposed to the 30-year AM. They won't give you as much interest only, but we use them as almost like a bridge, and we have no prepayment penalties. So we'll hold these deals for 18 months, possibly 2 years, and then refi them into agency. So I think there's a big component right there, because I think the agencies right now want 12 months of PITI. So that's going to really kill the deal for a lot of syndicators. And that's why those 4 caps, that 4 cap will never trade at a 4 cap in Knoxville right now. If it's a C asset, I'm saying it's at least going to go to a 6, if not a 7 cap right now. The next
it's kind of. It might even be like a C minus. Right?
Yeah, so you're talking 7 cap every day of the week right now, because there's demand, but and that kind of asset, you need a community. There's that, and that size, you're also looking at owner financing. Owner financing is going to come back roaring in the next 6 to 12 months, because a lot of these owners have a ton of equity. You can't get the financing, so I think a lot of people are going to be willing to take paper on a lot of their deals.
Interesting. So the 600, the $850,000 unit, and then the 136 was 4 point something, right? You said.
Mm-hmm. Yep.
Where did you guys get the money to buy that one?
So that one right there, our partner Mike was able to lend us $500,000 for part of the down payment. We needed 15% down. Remember the community bank? Mike lent us $500,000. We paid him 5% note from the property. When we bought the property, it was 80% occupied. They were using, 5 of the units as storage sheds. So there's so much upside. They're renting for $450 a month for 2 beds. We got them up to $595 on the first go around. They were right down the street from a manufacturing plant. So there was so much upside on it. They were running them so inefficiently, and basically expenses that were running at over $4,000 a door. We got them down to about $3,400 a unit. So we were able to cut the expenses. And Jake, what we did with that one, we were creative with Jake. He didn't have the capital. We gave him a 2% acquisition fee. So he rolled his AC fee into the deal, because basically he was the boots on the ground. He was going to the banker. He was talking to the broker. He was negotiating. He was doing all the work. So for Mike and myself, we wanted him part of the deal. So he was able to get 20% equity. For me, like I said, home equity line of credit. I pulled it out. I remember pulling the money out, and it actually was past the 10-year term. So for me, for a few months, it went to principal and interest, and it was killing me. But I was able to hold on, wait a few more months, and then we refied this property. I was able to pull that money out and pay my line of credit off. Mike was gracious enough, like I said, to lend us the $500,000 because he saw the value in the deal. So when we refinanced the deal, we paid off his note. And there was a point in this deal where we were like $50,000 apart, and my partner Mike did not want to go down anymore. And looking back, it probably would have been the stupidest thing I ever did in my life. But I said to Jake, we need to do something. We don't have 50 grand. And we went to the broker. Like I said, we had a great relationship. We said, Rick, would you mind taking a $50,000 second note for your part of your commissions? And Rick's like, yeah, sure, why not? So we ended up doing a $50,000 second. We were paying him like $300 or $400 a month on that note. And when we refied it, we just paid that note off also. So when you are out there and you're trying to make it happen, become as creative as possible. Jake goes to his grandparents, gets a loan from his grandparents. He blows up his 401k, whatever it takes to get that deal done. And this was a monumental, I guess, life-changing deal. This deal actually spawned Jake and Gino, and we're able, at the end of the day with this deal, we've been able to refi almost $4 million out of this deal. So, it's one of those deals where you see it. Wow. Have to do whatever you can. And it's one of the differences, I think, between being an entrepreneur and being a W-2 or transactional employee. The equity is what makes you rich in these deals. If you can get equity in these deals, an acquisition fee, and focus on the equity, that's when it's going to separate you by just paying bills and by becoming wealthy.
Were you nervous about this was all 2012, right? Or
this was 2000. This was 14. We actually did the closing on February 14th, which was Valentine's Day. And if your question was I nervous? I'm still nervous when I do deals. You know what I'm saying? You still get that, that nervous feeling in your stomach. You don't know if it's going to go right. You know what's going to happen. And that's why back then, if you just looked at the numbers and it made sense. Listen, rents were so low, expenses were out of whack. The deal was so far below replacement costs. We were buying these at 30 a door, and replacement, I don't know, right now is probably 100 a door. So we're buying them so far below replacement that it just made sense. And that's why, as we've seen these last couple of years with these deals going up and up and up, we're only able to close on 2 deals last year back in 2019 with all that capital sitting out there. We were on the road. I would probably say 250 to 300 deals last year, and nothing just made sense. That was making me nervous. When we found a deal that made sense, it's like, hold on a second. Is this deal good? Is it making sense? So for us back then, we were buying them so low and at such a low replacement cost that, there was a lot less downside risk in those deals.
So this big one, was this on Loopnet as well, or did this come off market through that broker connection?
It was on Loopnet, but like I said, it was listed at $6.3 million. So nobody was making an offer. It was just sitting there to die. And he had a great relationship with his doctor, and he wasn't a listing broker. I think a listing broker just threw it up there, but it was just sitting there to die. And that's one of those things where you don't have a great broker. Take it off. Just take it off market and start shopping it around. And my first offer to him was $4.4 million. From 6.3, I actually offered 4.4, and you can do that back then because that's what it was worth. It was worth around $4 million. The way they were running it. And back then with the financing, you had to buy it on actuals. So when we came in with that number, it was they came in and they appraised it at $4 million, or what we paid for it. So I was a learning lesson to me. And my broker always says to me, hey, no matter how low your offer is, it's the best one they've got all day. So that's the way I approached it. I showed him our underwriting, and he didn't blink. He went from 6.3. I offered 3.7, and he came down to 4.4 million in one shot. He came down $2 million in one shot. And the reason, Jay says he was motivated. He was a mom and pop. He had this property for 2 to 3 years. He was in partnership with his brother. So I'm sure his brother was always, complaining about his sister-in-law running the property, not managing it properly, and they just wanted it off their plate. They're doctors. They got into real estate with the idea that, hey, real estate is passive. You're going to make a ton of money. All know that's not the case.
Wow. Because now when you see properties listed on Loopnet, everybody throws in their pro forma and tries to sell it off of that.
Yep. And that's going to happen. But like I said, cap rates are going up, and we're going back to 13 and 14. We're going to go back to buying on actuals. You watch. And it's a good thing. And the other thing that I've seen, Jason, the last couple of weeks is brokers are actually calling us back, because they've got a lot of deals, and they've got a lot of deals that have been pulled off the market. And, that uncertainty, that the fact that, like I said, that deal, and you've seen in Knoxville, it's going to sit there and it is going to die. And then one day, 6 months from now, that seller is going to become so motivated that he's going to be like, you know what? What's the best you can do for me? And that's what's going to end up happening.
And I'll just take it.
That's right. And that's what happened, 4 or 5 years ago. That's what was happening. And then as the economy started recovering, as jobs started, coming down to Knoxville, as rents started pushing up, we were buying deals back then one beds were $350 a month in rent. So you can imagine they were trading at, 25, 30 a door. Once rents started going from $350 a month for one beds to $450 to $550 to $600, your NOI is starting to explode, and obviously, valuations go up.
Right. So big picture here, Gino, you're living in New York. Jake's down there. I don't know where your brother and this other partner were, but is it critical to have somebody with boots on the ground? Did you ever when you guys started buying out of state, I assume you started buying out of state. Did you just hire a property management company, or do you think it's critical to have somebody either in the city or in the location rather, or in close proximity?
That's a great question, Jace. When I started actually buying, back in 2010 in Rochester, New York. So I wanted to buy for cash flow. One of my mentors said, you know what? Buy for cash flow. Find a market with cash flows. And that's what Knoxville did. I mean, I was buying duplexes at $50 a door. I was paying, I was getting about $1,200 a month in rent, but these houses were old. There was no appreciation at all. The play there was hold them, cash flow them, get in Section 8 tenants, and you know what? 5 years later, that $50,000 unit home is going to be worth $50,000. So I started doing that, and I hired a property management company, and I actually had a great relationship with them. They did a great job. I was going to continue to buy up there. It's just that the prospect for job growth in New York was terrible. The taxes up there were so expensive, and I couldn't scale up. So it really depends. When you start out, you can go third-party property management. You don't need to be in the market. My only thing I would say is I chose Jacksonville and I moved down to St. Augustine 3 years ago is because I wanted to expand the portfolio down here. But if I wasn't living in Jacksonville, living in New York, getting on a plane in LaGuardia and flying to Jacksonville is an hour and a half. So you can live in close proximity and visit the market once a month, once a week, whenever you need to as you start growing. I think, hiring a property management company is key. Knowing how to hire the third party property management is one of the most important, aspects of it, because we talk about buy right, manage right, and finance right. That's our 3-step proprietary framework. And, if you execute the buy properly and you get great financing, they're done. The manage right is that wheel on the wheelbarrow that is in constant motion, and you need to hire a third party. For us, I just felt comfortable saying, Jake, you're down there. You don't know what you're doing. I'll coach you. I'll train you. We'll learn through the process. And for us, we got comfortable that way. But you don't necessarily need to live in the market. We just, that's what just happened to us. He just lived down there. And what Jake ultimately wanted to do was leave his job. That's what he wanted to do. And he thought that multifamily was the vehicle to do it. And that's why we chose to live in the market that we invested in.
Yeah, I want to talk about that in a second. But real quick, what do you typically look for in a property management company?
Well, if you're going to be doing small units, 10, 15, 20 units, you don't want one of these regional companies that are just going to look at you and you're going to be a pain in the neck to them. You want to really focus on a company that is going to serve the asset that you're actually investing in. If you're in single family home, same thing. Look for a company that does residential. I think the second thing, and most importantly, is right now we're going into this era of technology. If your property management company does everything by paper, you can't use them. I mean, there's going to be virtual leasing going on. There is going to be, virtual tours going on. You want everything online. You want the Gen Zs want actually to pull up their phone, pull a lease off their phone, be able to pay online. You want a company that's actually using technology. You want a company that's using software, property management software, whether it's, RealPage, whether it's Buildium, Appfolio. And you want a company that's focused on customer service, the customer experience. And that's what we say. There's a blue ocean strategy, like Jake likes to say, in the apartment space, in the C space. They're so underutilized with customer service. You want them to be responsive. You want them to have systems to be able to actually manage and actually deliver that customer service to the tenant. And those are some of the keys. I mean, going into it, it's a tough business, property management, because everything's going great. And then all of a sudden you have an issue and they get beat on. Right now, it's really difficult right now to start collecting rent. You have to have systems and you have to have policies and procedures. And that's what you need to look for. What are their KPIs? What are their process to turn a unit? What is the process to onboard a tenant? All of these things you have to think about and look at what the management company is actually doing.
Totally. So earlier you mentioned that Jake really wanted to transition from his day job, going from sales to real estate mogul, and you went from restaurateur to mogul. Can you talk a little bit about that transition, when you knew to take the leap and become 100% invested in real estate?
For me, it was a little bit different than Jake. He had, I think he had one child at the time. And he did a lot quicker because he had the property management income coming in, and he used cost segregation to basically wipe off that last year of taxes from his job, from his W-2. And he had that both. He had owner draws and the residual coming in from property management. For me, I can document exactly the time frame. So to give people an idea of, it's not going to happen overnight. It's not going to take you 12 months to do it. I started in 2011 with Jake. Like I said, our first deal was in February of 2013. In August of 2015, we bought an amazing deal. It was a 281 unit deal, $11 million owner finance deal. We put no money down. The owner held a 20% note. And I'm sitting at my restaurant. I remember, sitting in the shed, putting away all the catering tins and putting away the pizza containers and all. And I'm saying to myself, what am I doing here? I'm putting this deal together, and this has got the opportunity for me to actually get out of the restaurant. So I sat there and I said to myself, I need to make a decision. And, most people would have quit altogether. So I went to my brother in October of that year and I said, listen, I'm going to stop working at the restaurant during the week. I'm going to work real estate during the week, and I'm going to work with you on the weekends. So from October of 2015 to March of 2016, I was working 7 days a week. I wanted to make sure that the real estate worked. I wanted to make sure that I had enough cash flow coming in. I was living in New York. I had 6 kids. I had a lot of expenses. So I said, before I take that full plunge, let me go in, like the 10% Entrepreneur, that book, take a little small step. But for me, I was totally committed, working like crazy. I had started the podcast. We were writing the book. Assets. And, like I said, it was a 3-year period. And then at March of 2016, I said to my brother, I'm leaving the restaurant. You don't have to pay me. Whenever you sell this place, you can give me whatever is left over between the two of us. And I left. And in that 2016, I went down to Florida with my family. I spent a couple months down here to make sure that I wanted to move down to Florida because like I said, we were going to expand the portfolio in Jacksonville. And I was actually thinking, hey, you know what? I can start property managing some of these assets and make a property management fee. And 6 months later, we said, you know what? I'm moving down to Florida. So it was a good progression of about 3 to 3 years from when I bought my first property. And it's really basically, you have to have the mentality of you got to burn the ships. I mean, for me, those baby steps of knowing that I could do it and then ultimately saying, you know what, I'm going to take the leap. Because Jason, at the end of the day, if it didn't work for me, I could always go back and buy another restaurant. I can always go back and work for somebody else. But I would have hated myself if I didn't take that opportunity just to try it.
Totally. So now I kind of want to transition. How did you make that leap going from buying those properties yourselves with a couple partners to then kind of getting into the syndication game?
It was very difficult, and it's a different mindset, right? Syndication for me is just a tool in the toolbox. I think owner financing is just a tool in the toolbox. Partnering, JVing, there are other tools in the toolboxes. And for us, when we look at a deal, we've bought deals. Our first syndication was in November of 2018, and it was a smaller deal. Remember, I said, think big but start small. It was 132 units. It was a $6 million deal. And we were able to raise $2.5 million in 48 hours. But that progression of doing that, we had been doing live events. We had been building up our list. We had been talking about it. We actually had to hire somebody on board to help us with the investor relations, because it's a totally different business, syndication, as opposed to buying deals yourself. When you're buying a deal yourself, if you don't cash flow for 3 months, hey, Jake, you know what? We need to fix these septic fields. Let's not cash flow. Let's use the owner draws. You really can't do that in a syndication. And I think the exit strategy is a little bit different. With a syndication, you need to be crystal clear with your exit strategy. We talk about the 3 pillars in Jake and Gino of real estate. It's the market cycle, it's the debt, and it's the exit strategy. For Jake and myself, when we buy a deal, we can hold it long term. We can buy it and hold it forever, refi the thing out. But with a syndication, you have a totally fiduciary responsibility to your investors. You have to have a crystal clear plan of, you know what, we're going to hold this thing for 5 years. If we can sell sooner, we will. If not, you have to have that plan, and you have to really be completely transparent with your investors. We're having monthly webinars with the investors. We're sending out newsletters. During this crisis right now, we're having, on Friday between 2 to 4, our head of investor relations is having an open Q&A with the investors. So it's a totally different model. And for us, it was just easier to buy deals ourselves. And you just want to get into bigger deals. So I think syndication allows you to get into bigger deals. It allows you to diversify your portfolio because you have other investors. And it allows you also to create that other stream of revenue where all of a sudden you've got a syndication company that's creating and, collecting asset management fees, acquisition fees, And as a GP, you're putting money into the deal as a limited partner. So you also, cash flowing from that perspective also. So I love the strategy. It's just normally when people start in multifamily the last few years, they started with syndication. We did the opposite. There is no right or wrong way. I just had that limiting belief of, can I, buy a deal and make money for investors? And that held me up for a few years. But then once I figured out everyone else was doing it, I said, let me start partnering and let me start podcasting with syndicators who are doing it. Let me find out what the model's all about. And it took us a couple of years to learn. But after that, it's a great strategy to start scaling up and building your portfolio in multifamily.
Yeah, really good. I agree with all that. So just big picture here, Gino, is it too late for someone to jump into multifamily? And I just say that because you wonder, I mean, obviously it's never too late, but with how much capital is out there and how many people are now into it, 10 years ago, it wasn't as big as it is now, right? Now there's podcasts all about it. There's more websites, more blogs, people doing more deals. I mean, how does somebody get started here?
That's another great question. I always tell people it's the right time when you're ready. I mean, you have to be totally committed, just like anything else. You have to avoid the shiny object syndrome, which I had, mobile home park, fourplex, strip mall. I mean, I was not focused on one asset. You have to expect to play the long game. Most people don't want to think about, I have to wait 18 months for a deal. I mean, that's actually pretty quick a lot of times because you have to put the capital together. You have to create the relationships. You have to select the market. I think now is a great time to get into it because I think the economy is going to go in the tank for the next 6 months to 12 months. You need to start creating those relationships with the brokers, and you don't have to do it by yourself. You have to learn. It's education times action equals results. You need to get educated on the space. There's a lot to learn. It's not rocket science, but there is a lot to learn. And, real estate is a relationship-based business. And there's so many different aspects of multifamily, whether you're buying the deal, whether you're underwriting the deal, whether you're raising the capital, whether you're being boots on the ground. There's a place for everybody on the team. And for me, I always say to myself, it's the right time when you're ready. Back in 2013, I was ready. I was fed up with going to the restaurant. I was fed up with not making enough money. And I said to myself, what do I need to do? And it was just really, to me, all about the growth mindset of learning, getting in there, personal development books. I ended up going to life coaching school, which was one of the best things that I ever did because it was all about personal development. It was all about what I wanted in my life, about clarity. So I think right now is a great time. I think you're going to have deals out there in the next 6 to 12 months. The financing is going to be a little bit difficult on sheets. As long as you can bring value to somebody and partner with somebody on a value for value based relationship, you're going to be successful in this business.
Yeah, really good stuff. So really appreciate it, Gino. Thanks for coming on. Where can people find you and get a hold of you? I know you guys have a book out as well. Tell us a little bit about that.
Sure. JakeandGino.com. Go to jakeandgino.com/honeybee. The Honeybee is a book we just wrote. It's a business parable. You go on there. There's a few videos on the book. We have some audio on there. We have our credibility book if you guys want to download it and show. And, it'll show you our business plan and you guys can create your own. It's a great tool when you're first getting started. We have 4 podcasts. Just go to the Jake and Gino channel on iTunes. We have a podcast called The Multifamily Zone. My wife and myself do the show. Spousal relationships, communication. Then we have a show on syndication called the RAND CRE. We have a Movers and Shakers podcast for our students, that are closing deals. And then we have the We Will Our Profits podcast.
Awesome. Thanks again for coming on. That's Gino, over 1,500 units and over, right? $100 million in multifamily assets. So thanks again for coming on. Really appreciate it.
Thanks, Jake. Thank you. Appreciate it. Thanks for having me.
Thanks.
Thanks for listening to the Millionaires Unveiled podcast with Clark Sheffield and Chase Mattinson. For more stories, investment opportunities, and information, check out our website at millionairesunveiled.com. See you next time when you'll hear from another everyday millionaire.